Good day, fellow investors. JD here reminds us of Alibaba just 12 months ago. Huge cash compared to market capitalization, low price to earnings, price to cash flow ratios, and as Alibaba doubled over the last year, perhaps so will JD. And on my research platform there is a suggestion part, but also under each analysis there are comments. And as JD stock developed over the last year, now there are requests for updates. It looks cheap, but there was also a great comment from Ivan here discussing the strong infrastructure, nationwide, automated, improving margins, controlling the whole chain, building infrastructure. But it is investing heavily into building that, let's say, spine that can deliver value so that other competitors don't come in, which is then a moat. Only around 15% of revenues come from logistics, but it supports everything else. So I'm going to analyze it here to see whether it fits one of my at least good buys. If it can double like Alibaba, it might be interesting for some of my portfolios. Let's then do an analysis. If you like such an analysis, smash that like button and subscribe if you haven't. Let's immediately look at the stock. It's traded also in Hong Kong, secondary listing there. Market capitalization $46 billion, P ratio 11, and we are at the 52-week low, 29, peaking above 100 just a few years ago when there was huge growth in these businesses in China. However, it has been an ugly last 5 years for the investors, but it is still one of the leading e-commerce, logistics and other platforms in China. And there is JD Retail, cross-border e-commerce. They are now expanding with their Joy Buy, the European retail businesses. They made an acquisition, now in the process of regulatory approvals. JD Logistics, of course, JD Technology, Health, Industrials, Property. And of those, JD Health, for example, is listed in Hong Kong with a significant market cap. What's that? 30-something billion dollars. JD Logistics also listed in Hong Kong, $11 billion. So when you sum these things up, plus there are other interesting listings to come, when you sum those things up, there is already significant sum of parts value too, like Alibaba and financial and other things. They own 67% of JD Health. Gemini doesn't know what's the ownership of JD Logistics. They also bought out Data Nexus, which was listed, IPO of JD Industrials. So there are a lot of things that are happening. The IPO price of Data Nexus is 16, peak 60, and then offered $2 per share. This is how some of these Chinese investments end up. But all these companies, the Alibabas, they are just like throwing spaghetti at the wall, and if something sticks, that can be very, very valuable. And that's also JD. They are trying, competing, and then seeing what sticks. If we look at the key valuation factor there, this is in US dollars. So we have 16 and 12, 28, 27 something billion dollars compared to the market cap of 46. That's more than 50% in cash of the market capitalization. The current liabilities are mostly related to business and just $5 billion of long-term borrowings. For 42 billion of shareholder equity, of that pretty much in cash. That is something big. I don't think Alibaba's cash pile was that big. It was, I think, 50 billion on the low, around 200 billion market cap. So we are here twice what Alibaba was. Let's look a little bit more into the current numbers and the earnings. Recent highlights. everything still looks good. Revenues growing 14%. There was a small period of stagnation and now everything is going higher. Profitability is going good. Margins are improving. It seems okay. JD Logistics booming. New businesses also booming. And you can see here profits significantly improving, going from 2% to 4%. However, when it comes to these profits of JD, it seems they also can play around with those profits. Those were low as they compete to gain market share. Then, of course, the pandemic, appliances, things like that, they had this positive. Then again, high competition, and then they, let's say, slow down revenue a little bit, improving the margins, and now they have to compete again, and then the margins decline. But all in all, revenue grew faster than anticipated, good sales, and they are also acquiring CC Nomi in Germany, trying to acquire in the UK, but that didn't work. Anyway, they also going into food delivery, competing with Meituan and Alibaba, but that fierce battle is eroding industry-wide margins, and that is always the problem with these retailers, the competition, the battle, and you never know when there will actually be a moat that delivers long-term profits. Cash flows, good cash flows, this is $5, $6, $7 billion. Free cash flow, significant. They are now investing a little bit, I think, into that customer and things like that, lowering prices, that means to compete. But okay, the cash flows are still there, compounding the cash that is already there. New business and trade-in program, food delivery, and all that they are doing. All in all, we have good cash from operations, declining a little bit, but that goes up and down. We have standard capital expenditures, repurchases. So now that the stock is lower, this is what I like when a management buys more when a stock price is lower. We'll see whether they did that in just one quarter last year. We'll see if they repeat it now. So that is questionable, and there is also small dividend. But the market is afraid of the low recent margins. So the key question is, okay, when are they going to make money to send you a big fat dividend check or growth or fat buybacks? When they're going to distribute? That's the key question here. They are doing that a little bit here and there, but still they are always investing in that business for growth, for improvement, which makes the business here to stay. And given the equity close to the market capitalization, the infrastructure, that is extremely valuable, what they have already built. Somebody would buy it at a fair price. So we can already, with the cash and everything, we can start building some pillars of a margin of safety. I've looked a little bit at what's discussed, what are the analyst concerns, so subsidies, fading, JD Joy, overseas, and always the management's answers is we are building a long-term foundation, but all the Chinese retailers say that. And we'll continue to offer users the best value for money, better experience, but that all costs cash flows that can be diverted to shareholders if it wouldn't be like that. And they are now investing Chinese supply chain, long-term investments, Europe, still in the test phase, but Temu did pretty well in Europe, so we'll see how they can perhaps challenge that with the bigger items. And very good question here, how long are you going to lose money with food, with competing with Meituan and Alibaba? When are you going to give up? And again, long term, everything that doesn't make money is always long term. For those who are interested in Meituan, I have discussed it in this video just 2 weeks ago, I think. Same as everyone, investing, JD, AI, so investing also in AI, outlook, and then the key question is always the outlook in terms of profitability and margin in the next few years, and you can already guess we are investing for the long term. But those developments of the ecosystem should at least, hopefully, maybe one day give good margin expansion and stable positions. Whether that will happen and when will that happen, we don't know. However, JD Retail's gross margin has been expanding year on for 14 consecutive quarters. So a good retailer, e-commerce, steady growth, okay profit, so nothing wrong, plus the cash. Now let's look a little bit at what's going on with the competition. Pinduoduo holdings, so the Temu, everyone is crazy in my country, in Croatia. My father is buying, my brother is buying, so it's getting too crazy. But they are also really pushing it on those strategic initiatives, supporting the customer, thus lowering prices, fierce industry competition, a global complex environment now with tariffs, with new rules also in the European Union. So the question now is, will that slow down over time? And here the management of Pinduoduo is very open and saying how their growth rate is set to slow down and also not be linear. So this has been some staggering growth. Even they managed to do it profitably, which is a miracle, but the competition is intensifying. It's not sustainable what they are doing because you need to make money. They likely make money in China, but the others are also playing that game, and that lowers margins for everything. The cash is there, but what are they going to do with the cash? That's always the same question with these Chinese companies. Alibaba recently just reported earnings. I have sold Alibaba just a while ago as it doubled from my entry prices. That was okay. It turned from a retailer, cheap cash, to an AI bet, which makes it simply too risky for that exposure in my model portfolio. But okay, I'm still covering on my research platform, so it's good to make an update. Now, revenue slowly growing as they have disposed of some things, but the key here, when you look at the profitability, is it almost halved. So they are increasing the investments everywhere, and you can see also income from operations down almost half, 43%. Similarly also cash flows. There are a lot of cash and other liquid investments, 80 billion, but the cash is being used for investments, for loans. So this, I think this was 60 billion, is now already down to 40 billion. The key here also, EBITDA, when you look at it, down 47% on those investments everywhere. Investments everywhere, we can call it, but still 10% growth, it looks good, and Alibaba is not a business that will disappear that soon. Something very interesting here, I always like the global growth, but now it has grown only 11%, which is among the slowest of the growth rates there. Cloud, on the other hand, is booming, but that is just a small part of the business. And all the others, remember the pasta, is going to zero, forget about it. So Fresh Hippo, Health, things like that, they try, but if it doesn't work, it doesn't work. And the logistics part that was so valuable is now all others kind of forgotten. Very interesting how quickly that changes. Nevertheless, free cash flows, 5 billion negative, compared to a big positive a while ago. And they are investing AI, cloud, quick commerce, all those things that, yes, it might work, it might not work, there is value, but it's not the great value that we have been used to a year something ago. So things are changing, businesses are changing, you just have to see how it fits your portfolio. Alibaba, it will likely do great, it will likely build great things in some of the segments. The other segments will fall like pasta on the ground, but that's where we are now. Let's see the JD stock valuation there. If we look at what analysts are saying, strong buy, therefore it is a buy for Wall Street. Just one strong sell and one hold with on Wall Street is sell. The same as Alibaba, their target price is 46% higher for the stock. And when it comes to these Asian companies, it's always to look at the Asian side of analysts. So they have also update at DBS is something that I just look to see what is going on there, what are they doing, and okay, company overview from the overview. But 18% market share, food delivery is expected to see sequential loss reduction over time, which should improve margins. So we have a target. This is a little bit less upside than Wall Street, but okay, forward P ratio 14, price to book 1.5, good return on equity. And they have a target, improving margins, things continuing like they are good. The main risk is an economic slowdown and more competition. And here you have their projections to the next 2 years, going into P ratio of 9 most likely. So that P ratio of 9 cheapness reminds me of Alibaba just a few years ago. We were buying here, so that did well just a little bit here, averaging down. I think I also bought here and sold here, but that's a different story now. So how do we value JD? Cash per share, P ratio, growth, all of that together. Net cash per share, 15, a little bit more maybe, okay, when you take the debt, depending on what you're taking there, what Gemini has taken here. So let's say 50%, P ratio 13 going to 9. The growth is there and will likely be there as they scale. They have been growing over the last decade. So we have a margin of safety in the cash, low P ratio, great ecosystem, logistics, good position in the market. The question now, is the stock a buy? And if I look at things, I think that this, with 1 year of good news, of growth, can easily be a 50 stock, which would give you 60% upside. So from that perspective, it looks like a buy. Low P ratio, cash, good business, dividend 3%, possible also buybacks, the long-term goal, the infrastructure. In a diversified portfolio, it should fit. The risks are the economy, China, and also what we already mentioned, competition. So, as said, you will likely make money on this, especially if you have a staged approach. So you buy now, if it goes to 20, you double down. When it comes back to 30, you sell the first part. When it goes up, you buy more, all else equal. However, when it comes to my personal taste, okay, Alibaba had always that something, the ecosystem. You knew they were playing on all this, touching all these things that might work better. JD is more like a down-to-earth retailer where those upsides, the cloud, the AI, the things, the end financial are not there. That's one thing. So, okay, plus it is, as would Charlie say, it's just a damn retailer. And I personally need to find better. I need to find that beautiful, that is not priced in, that gives me more certainty into long-term growth, even if perhaps I missed on Google, but there are always these risks. If they materialize, then it doesn't look that great. So for now, I'm not going to put it into my portfolios because of the competition. I want something where I know that there is no competition. And if Elon Musk builds a factory in China in a few months, there is a better one next to his one. Talk to BYD. So that's something that no matter what you build there, somebody is going to build better. There is money, investments, things like that. So yes, the cash is there, but not distributed to us. So that's always a question. Alibaba also. Cash is now shifting towards investments. Okay, should be good investments, but that's again Alibaba, which is a bigger player, better positioned, I think, perhaps in the ecosystem. So, very interesting situation. I might keep on following. Can I put it on my quadrant? I would put it maybe around the 5% return, 3% buybacks, but there is still growth. However, how can that dividend growth really truly be there? A little bit risky, so it's not like I can project cash flows for the long term. So for now, let's stay at this video, and I'm sure that you in the comments will remind me if something interesting happens. I hope you enjoyed my analysis. If you want to play with it, play with it. I'm just personally, I have the need to search for much better.